The stock market just had its worst week in over a year. The S&P 500 dropped 2.6%. Technology stocks fell 5.6%. And our own value-aligned portfolio was down 3.8% after fees. A week like that can turn your stomach. So here is the part that matters most. The businesses we own did not get worse. Their stock prices went down, but the companies themselves stayed strong. In the next few minutes, I will show you what happened, why it happened, and why I think our plan is in better shape today than it was a week ago. I'm Burke, and this is the weekly market and value-aligned portfolio review for the trading week of June 1st through June 5th, 2026. One quick note before we start. I am a guide here, not a guru. I am not going to tell you what to do with your money. I am going to show you how I think through a week like this. And you can take what is useful for you. Here is our path today. First, what happened and why it does not change our thinking. Second, a fast recap of the US market. Third, the economy and the Federal Reserve. And fourth, our portfolio and what comes next. Let me start with the scoreboard. The S&P 500 fell 2.6%. The S&P 500 is an index, which is just a basket of 500 of the largest American companies that people use to measure how the whole market is doing. Technology stocks fell harder, down 5.6%. Almost all of the selling was packed into one corner of the market: artificial intelligence companies and the biggest technology names. The rest of the market barely moved. Hold on to that detail, because I will come back to it. Here is the key idea for the whole week. Prices fell. The fundamentals did not. Let me explain what fundamentals means. Fundamentals are the real health of a business: how much it sells, how much it earns, how fast it is growing. None of that got worse this week. What changed was mood. Investors got nervous and sold. We call that a sentiment event, which is a fancy way of saying a mood swing, not a sign the companies are breaking. And remember where these stocks came from. Going into this week, AMD was up 117% for the year. Semiconductor stocks, the companies that make computer chips, were up 58%. Technology overall was up 25%. When prices run up that fast, people lock in profits. Now, to the part that has me excited about the months ahead. The case for falling inflation. Inflation is the speed at which prices for everyday things go up. We measure it with something called the CPI. What is the CPI? It stands for Consumer Price Index. Picture a basket of common things a family buys: food, gas, rent, clothes. The government tracks how the price of that basket changes over time, and that is the CPI. Right now, core CPI is around 2.8%, and it is forecast to fall below 2.2% this year. Some narrower measures are already down at 1.2 to 1.3%. Here is why prices are cooling. Productivity is rising 2.8%. What is productivity? It is how much a worker can produce in 1 hour. When a worker, helped by better tools and now by AI, can make more in the same hour, companies can pay people more without raising prices. Wages grew just 0.3% for the month, which is steady, not hot. Two investors I respect see the same picture. Cathie Wood, who runs ARK Invest, and Ron Barron, who runs Barron Capital, both argue that AI and robotics are letting the economy grow while inflation cools. Stores like Walmart and Costco are using that efficiency to hold prices down instead of passing increases onto you. This raises a fair worry. Are we in a bubble, like the dot-com crash back in the year 2000? Ron Barron makes the case that we are not, and the numbers support him. In the dot-com era, companies were spending 5 to 6% of the entire economy on building out technology. Today, spending on AI is only about 2% of the economy. A quick term here: CapEx is short for capital expenditure, and it just means the money a company spends on big, long-term things like buildings, machines, and computers. So AI CapEx is still small. Now look at the size of the prize. All of technology is about $5 trillion of a $110 trillion global economy. Human labor is 45 to 50% of it. And GDP, by the way, just means the total value of everything a country produces in a year. Goldman Sachs estimates the 500 largest U.S. companies could save $925 billion a year from AI by 2030. The room to grow is enormous. This looks like the early part of a new industrial revolution, not the end of one. Want to show you a picture that proves the selling was narrow. There are two ways to measure a group of stocks. The first is cap weight, short for market cap weighted. In a cap weighted index, the biggest companies count the most. So, if a handful of giants fall, the whole index looks like it fell hard. The second way is equal weight, where every company counts the same, big or small. Now watch the gap. The equal weight S&P with the ticker symbol RSP was down only 0.5%. The regular cap-weighted S&P, ticker SPY, was down 2.5%. The Nasdaq Tech Fund, QQQ, was down 4.5%. And the Tech Sector Fund, XLK, was down 5.6%. Read that spread. The typical stock had a normal, quiet week. Only the very biggest stocks had a rough one. That is not a broken market. That is a few giants taking a breather. Money did not leave the market this week. It moved around inside it. We call that sector rotation, which means investors shifting money from one part of the market to another. This week, the winners were energy, up 2.5%, healthcare, up 2.4%, real estate, up 1.6%, and financials, up 1.4%. The losers were technology, down 5.6%, consumer discretionary, down 5%, and communications, down 3.5%. Consumer discretionary means companies that sell things people want but do not truly need, like cars, restaurants, and vacations. And even after the drop, semiconductor stocks are still up 58% for the year. That tells me this was profit-taking, people cashing in some of their gains, not a change in the long-term trend. Now, let me explain the most important policy change happening right now. The Federal Reserve, often just called the Fed, is the central bank of the United States. Its main job is to set interest rates, which control how cheap or expensive it is to borrow money. The new head of the Fed is Kevin Warsh, and Warsh thinks differently from the people before him. There is an old idea in economics called the Phillips curve. It says that when lots of people have jobs, prices must go up. Warsh rejects that idea. He believes that if workers keep getting more productive, the economy can run hot and inflation can still fall. Because of that, he may cut interest rates even while the economy is booming. Lower rates tend to help stocks, especially fast-growing companies. Here is a telling sign. The price of gold peaked the very day Warsh was appointed. Gold usually rises when people fear inflation. It started falling the moment a man known for fighting inflation took the job. Put the pieces together and you get what investors call a Goldilocks setup. That means an economy that is not too hot and not too cold, but just right. The jobs report showed 172,000 new jobs, far more than the 88,000 people expected. Those are called payrolls, which is simply the count of how many jobs employers added. Wages rose a steady 0.3%. The federal deficit, which is the gap between what the government spends and what it collects, is set to fall below 5% of the economy in 2026. And company profits earned here at home are near a record share of the economy. Strong jobs, calm wages, and falling inflation. That is a healthy backdrop for the businesses we own. Now, let me show you why demand for AI is not slowing down. It keeps growing in three places. First, pre-training, which means building bigger and smarter AI models. Second, post-training, which means teaching those models to improve through practice. Engineers call that reinforcement learning. Third, test time compute, which means letting the AI think for longer before it answers. Every one of these needs more computing power. A quick word. Compute just means raw computing horsepower, and the chips that do most of that work are called GPUs, short for graphics processing units. The most demanding new AI model, called Grok 4, used more than 200,000 of NVIDIA's GPUs. Here is a number that stuck with me. Every gigawatt of new AI infrastructure, which is a measure of the electrical power for these giant data centers, turns into $40 to $50 billion of orders for NVIDIA. This build-out is still in its early innings. The story keeps widening beyond chips. Here are three examples we are watching. Arista Networks builds the plumbing that connects all those chips together, and the industry is shifting toward its style of networking. Shopify is moving into what people call agentic commerce, where an AI assistant shops for you and places orders on your behalf. And Tesla's Optimus is a human-shaped robot built to do real physical work. Each one is a different door into the same trend. Machines doing more of the heavy lifting so that people can do more. What could happen next? The big test is the next inflation report, due June 10th. First, the bull case, which is the hopeful path. Oil prices fall. Inflation confirms it is heading toward 2.2%. Warsh signals rate cuts, and the AI leaders pick back up where they left off. Now the bear case, which is the path that would hurt. The AI sell-off spreads wider. Weaknesses in software companies grow. Warsh stays patient, and holds rates steady. And our portfolio keeps lagging for a while. I'm not going to pretend I know which one wins in the short run. And here is one honest risk worth naming. AMD is close to 10% of our portfolio, so a single AI stock can swing our results. We watch that closely. Step back from one rough week, and here is where I land. Our thinking is stronger than it was 7 days ago. Productivity is rising, inflation is falling, and a wave of new businesses is about to take off. We own the companies building the next industrial revolution. We look for businesses that can double in 3 to 5 years, and owning those means sitting calmly through weeks like this one. I had a client call me on Friday, worried, with her finger hovering over the sell button. We walked through these same numbers together, and by the end of the call, she felt steady again. That is the whole job.